For generations, traders, investors, we've all been kind of searching for that one secret formula for market success. We hear these legendary tales.
Yeah, stories about unique methods, magic tricks almost.
Exactly. But what if the real secret isn't some hidden trick? What if it's more about, well, a shared wisdom? We're doing a deep dive today looking at Jesse Livermore, William O'Neill, Nicolas Darvas, these giants.
And what's fascinating, really, is that they weren't operating with totally different playbooks. There's this unified philosophy underneath it all.
A unified philosophy.
Yeah.
Interesting.
Yeah. So this deep dive, we're going to try and distill that. Boil it down to maybe one core golden rule that still works for swing trading today.
Okay, I like that, a golden rule.
Yeah.
So what is it? Let's unpack it.
All right, so boiled down, it's something like this. Trade only with the main market trend. Focus only on the very best, leading stocks breaking out from solid price patterns. And this is key. Protect every trade with a strict, preset stop loss.
So it's like a whole system. Trend, stock entry, and that safety net, the stop loss.
Pretty much. 3 pillars and one absolutely unbreakable rule. It cuts through a lot of the noise,
Okay, let's break down those pillars. Where do we start?
Let's start with the first one. Market direction. Think of it as the tide, aligning with the overall market. It's like financial gravity. It's almost a prerequisite.
Gravity. I like that. So ignoring it is like jumping up expecting not to come down.
Kind of, yeah. Livermore, he got this. His big money, as he called it, often came from just sitting tight, waiting until the market showed its hand clearly, the line of least resistance, he called it.
Sitting tight. That sounds harder than it looks.
Oh, it is. Discipline. And O'Neill, he backed this up with data, found that like 3 out of every 4 stocks just follow the market trend, trying to fight it. He said it was like swimming upstream in a rip current.
Wow, so even the best stock pick can get dragged down if the tide's going out.
Exactly. It's actually a huge risk management tool, just knowing that.
Okay, so you've got the market wind at your back. What's next? How do you pick the right boat?
Perfect analogy. That brings us right to pillar number 2, stock selection, or the strongest ship.
Strongest ship. So not the leaky ones hoping for a patch job.
Definitely not. This is where it gets counterintuitive for some. They all agreed. Put your money in the strongest stocks, the leaders, not the beaten down ones. They actually said, buy high and sell higher.
Buy high, sell higher. That goes against everything you usually hear, like buy low, sell high.
It does. But O'Neill, he really systematized this. He developed the relative strength rating, the RS rating. Basically, it ranks stocks based on price performance.
Okay, so how strong are we talking?
He looked for stocks outperforming, say, 80 or 90% of all other stocks. The absolute leaders. These are often companies with huge earnings growth, new products, stuff that attracts the big institutional money.
So you're kind of riding the coattails of the big players.
You're essentially piggybacking, following the big money flow.
Okay, market direction, check. Strongest stock, check. Now, the timing. When do you actually jump in? And maybe more importantly, when do you get out? That feels like the real trick.
Right, that's pillar 3. And it includes that unbreakable rule we mentioned, entry and risk management. Let's call it the breakout and the lifeboat.
The breakout.
Yeah. The common trigger for all of them was a stock breaking out of a consolidation period, like when the price has been trading sideways for a bit, building energy.
And they all saw this. Livermore, O'Neill, Darvas.
Yep. Livermore called it a pivotal point. O'Neill, a sound base. Darvas had his box theory. The names differ, but the concept's the same. It's not predicting, it's reacting when the market signals readiness, often with a big surge in volume.
Reacting, not predicting. Okay, but what if you react and you're wrong? What if the breakout fails?
That's where the lifeboat comes in, the non-negotiable part. That hard stop loss. O'Neill was very specific, 7 to 8% max.
7 to 8%. And that's it. No hoping it'll come back.
Absolutely not. It's not just about cutting a loss. Think of it as a diagnostic tool. If a stock drops that much right after you buy it, the market is basically screaming that your initial idea was wrong. Time to get out, reassess.
Wow, that takes serious discipline.
It does. And look at Livermore. He never averaged down on losers, never threw good money after bad. He only added to winning positions, pyramiding up. Darvas used a trailing stop, moving his exit point up as the stock climbed, protecting profits. It's a whole system for managing the trade's life cycle.
So it all ties together. The trend, the leader, the breakout, the stop.
Exactly. Their enduring success wasn't some arcane secret. It was this shared grasp of market fundamentals and, crucially, the discipline to stick to the system.
It's fascinating how these core ideas keep showing up. So thinking about this, What does it mean for you listening right now? This wisdom, it really challenges a lot of conventional thinking, doesn't it? The power of sometimes just doing nothing, sitting tight, or that idea to buy high and sell higher. How might these, well, maybe counterintuitive insights apply not just to trading, but maybe to other big decisions you make? Something to think about.